Okay, good afternoon, Futex traders and everyone else around the world listening in. Welcome to an afternoon FX and commodities stream on the 6th of July 2015. In today's stream, we're going to be covering the Greek effects and potential, how severe is the Greek contagion. We'll be looking at a few charts and then a kind of a special analysis of where is the next risk on the global markets. We're going to be looking at some keynote charts as well as trying to really do some technical regression analysis of what could be systemic going forward. So let's kick off by what the media is really looking at the moment, and do remember the media is always behind and price is always ahead, and this is what gives us that advantage by being in front of your screen, seeing what the charts are doing and seeing especially the order flow on the price ladder. So what we have, and I've got up here, is the Greek versus German 5-year spread, and as you can see from last week's close, we've jumped up another 600 basis. So that's from just below 24% to 31%, and last week when we the Friday to Monday when we had the call of the referendum, the similar type of move. So you can see, just within the localized Greek economy, and the cost of borrowing has really shot up aggressively within the space of a week. I mean, we're talking about when the referendum was called, we're sitting at a Greek paper to German, a 5-year paper was sitting around just about 15%. We have now doubled at 31%, and both weekends have had the same type of magnitude of a move. Now let's try and see if the so-called economic distress, whether this has really been able to go up against the shores and send out this Greek economic catastrophe past the Aegean Seas and past the Mediterranean into other economies, not only within Europe but around the world. And if we just look at the so-called ones that are really the closest to receive a cold from the Greek flu, if we had to look at the Italian 5-year against the German 5-year, you can actually see we still have not taken last week's move, last week's spread high. And so again, German 5-year against the Italian 5-year. You can see last week we really traded as high as 1.3%, and you can see the magnitude of that move from the Friday close to the Monday high in the spread. Is the move, given that the event that happened on the weekend and the so-called no vote that was going to be catastrophic and potential leaving of the Eurozone, well, the Italian 5-year to the German 5-year has really shown that at the moment, every single time there's a cough, it's just getting less and less severe. And in this case, we moved from Friday's close from 20 basis compared to last week of almost 60 basis. So really that's showing you just the lack of potential, and these are countries that are the most sensitive to the Greek, the so-called pig nations, that was coined that phrase, and when the whole European crisis started in earnest. So that is the Italian against the 5-year. Now against the German 5-year, if you go against the Spanish 5-year, again, this is last week's move, powerful move, and this is now this Monday's move, less pronounced than what we had last week. So again, just kind of showing you that the market is not reacting as aggressively and as the media would like us to think. All the answers again are in the chart and on the price ladder. And if we look at Portuguese paper, so again, Portuguese paper, literally trading out the highs of last week, but again, the magnitude of the move, it is slowly trending up, but not as powerful as it was a week ago. And again, we're waiting for some more clarity of whether there will be a deal over the next 48 hours, but this can kicking now could continue for indefinitely. You just don't know how long it can really continue. The market seems to be becoming a little bit lethargic to this news, and again you can see that the most sensitive sensitive debt assets and sensitive government debt assets to Greek paper isn't being as influenced, whereas your Greek paper, again, I'll bring up this chart, is having the same magnitude of the move, if not a little bit more, but it's not really resulting in a ripple effect into those countries. So just something to keep an eye on, and seeing, how important this is becoming, or whether this risk will slowly start disappearing into the ether. Now, what is going to be important going forward, and something that's really caught my eye over the last week, and then again especially this morning, and if I bring up the rebasing chart, now what I want to show you is in the overnight markets. So we had all this media news about Greece, and about the no vote that was going to be systemic, but then you come in on a morning like today and you see the currency moves that have happened since the close of Friday until this morning. And what you have over here is you don't have the, again, those of you who don't know this rebasing chart, I set all the currencies at 100 against the US dollar, and then anything below the 100 mark shows the underperformance against the US dollar, and anything above the 100 mark shows outperformance against the US dollar. So you just see relative performance in a really nice, in a very easy interpretive fashion. So as you can see, we come in this morning, and the currency that's really getting slam dunked is the Australian dollar. Now, we do have a dual event risk in the form of the employment data out this week and the RBA meeting. And then the next one you have is the Canadian dollar, and only then you have the euro with the Kiwi dollar very near that. So the euro really hasn't, on the overnight currency moves, hasn't really been the story. And then you've had the risk off flows where the Japanese yen has really received the majority of interest. So you look at that. Now, if I had to set this a week, so if we had to say, this whole week since the referendum was called, and we take it from Monday last week, okay, so we'll take that from Monday last week. Now, what you can see over here, with all this Greek news that's been coming out the market, what's going under the radar is this Australian dollar over here been performing weaker than the euro, the Canadian dollar weaker as well than the euro, as well as the New Zealand dollar, with the yen, with everyone actually underperforming against the US dollar. And then you have the British pound and you have the Japanese yen over here. Now, what has happened over the past week or couple of weeks is the Shanghai index, and the Chinese market has recapitulated 30% from its peak, and with that it's really started bringing down the so-called commodity currencies. And these commodity currencies, namely you have Australia, its biggest export partner being China, with especially iron ore, and we'll look at the iron ore prices in a moment. You have the Canadian dollar, which is again a commodity currency reliant on the oil industry, and then you have the New Zealand dollar, which also again supplies China with its dairy produce and possibly the Kiwi lambs. But all of these currencies have really taken the brunt of the move. And if we look at the Shanghai Composite Index, this now is from the peak, this is a severe and brutal move that's happened in China, and simply because all of this Greek news, it's literally hasn't really captured the attention of the media yet. But again, that could all change in the next week. But the Shanghai, off its peaks over here, just above 5,100, has come all the way to as low as 3,600. And then during the Asian session, we had quite a steep sell-off. We had a gap up on the open, and then a sell-off almost to last week's low. And then we've got this key area over here, this 3,400 area, where we really spent a good part of the middle of the beginning of this year building some type of continuation formation before we breached towards the upside. So that is your first kind of little area of support. But what I want to show you, even more interesting, what I have over here is the Canadian dollar in purple and the Australian dollar. Now you can see really how they're mimicking each other, and I know quite a few, I've got a couple of friends who trade some spreads out in Australia. They trade the 10-year, and you can trade it on the futures market, the 10-year Aussie against the CGB, and it's possibly a market, well, they've been trading it recently just simply because the currencies have been moving pretty much in sync. So you're effectively hedging out the currency fluctuation with the execution of a spread that should be pretty much in line. But what's very observable is when we had this move down, so after we had this bounce and we had this move down on this day, and that day was the 25th of June, and we've just had a one-way move after this little spike over here. That was also the high, the recent high in the Canadian dollar as well as the Australian dollar. So this correlation between the so-called major commodity currencies such as your Australian dollar, your Canadian dollar and your New Zealand dollar up against the Chinese market, the correlations are really picking up quite significantly, and you're starting to have significant correlation. And this, to me, is a risk that you just need to keep a very close eye on, because if something ever does happen in China, and China does not find support at the 3,400 level, well, this could be the systemic influence, because China has more economic clout than unfortunate than the Greek and all of its little islands on the periphery will have on the world economy. So again, last week's story in the currency space was all about China. The media noise was all about Greece, and justifiably so. We've reacted, and we've had some big moves, but there's an underlying current that's sweeping through the Chinese stock market. And again, now if we look, it's not just the commodity currencies. If you look at copper, one of the biggest imports for China, you can see how copper on the overnight markets has absolutely capitulated, and you can see it's just been trending down for the large part of 2 months, and also coincides since the Shanghai moved down, from the mid-June area. So that's your copper prices really moving down quite aggressively. So you can start seeing this picture that I'm trying to paint for you of not only with Shanghai, but how the stock exchange of China is affecting not only commodity prices but also the various currencies. And this now is your platinum price, and a big move in the overnight, big move in the Asian session, approaching multi-year lows, as you can see. So that is platinum. And then even the palladium, sorry, that's not, where's my, the iron ore price. So I don't have palladium. So the iron ore price, which is Australia's biggest export to China, you can see has also literally capitulated when it found a little peak at 65, and has also sold off quite aggressively. So there is a slight theme and a potential canary in the Chinese coal mine of some risk coming into China, and this risk, will it be felt by the US stock markets and the European stock markets? So going forward, I'm going to be keeping a very close eye on moves in the commodity currencies, in the commodity complex, and then also in the Shanghai Composite Index, because this could be the next litmus test for the strength of the global economy. So keep an eye, it's a little bit a different stream than what I've done in the past with looking at key futures levels, but we really wanted to bring to your attention of maybe a bigger macro theme that could be developing, and macro themes then start developing into intraday trading opportunities. From the perspective of what you could trade, well, anything relating, it depends how systemic China gets, but the first market that will be sensitive to it that we can trade is the Australian dollar, as well as the ASX, another futures market, which is the Australian Stock Exchange Index. And then you have the 3s, 10s, and then you also have the Canadian dollar against the you also have the Canadian dollar to trade, and the New Zealand dollar. And do remember, the Australian dollar that is influenced by any of this. We want to see what this RBA meeting could be rather juicy on what they feel the prospects of China is going forward. And remember, Australia still has room to maneuver on cutting rates further, even with a fairly frothy housing market in suburbs such as, or in cities such as Sydney. Okay, all the best. Now remember to manage your risk capital this week, manage your emotional capital, and when the probabilities of the trade lineup, execute with conviction. This is Alex Hayward signing up for the Futex Live FX stream.